If the Mag 7 stocks are getting ready to decouple, which names could be a best bet for 2026? With us now is James Cakmak, portfolio manager at Clockwise Capital. James, it's great to talk to you. So Mac did a great job there of sort of laying out why we're going to see this big gap widen. Which of these companies do you think is still set to take on the debt and still demonstrate to investors that there was a reason to get in?
Yeah, I mean, we own pretty much all of the Mag 7 and then some. But at the same time, we're looking at where do we want to be overweight, where do we want to be at parity, and where do we want to be underweight. And really, it's just three stocks that we continue to be overweight. That would be Apple, that would be Broadcom, and Micron, which is not in the Mag 7, but it is part of the NASDAQ index that we're overweight on. So, we do think, well, you got to take a step back and look at what are the growth assumptions as you look into next year? What are the margin assumptions as you look into next year? I know we're talking about this $300 earnings number for next year for the broader S&P, but at the same time, that number really hasn't changed from a year ago. The earnings expectations have largely been intact, and I think this multiple surge that you've seen in the market is largely a function of overestimating on the performance relative to where we were post Liberation Day versus where we are in an absolute sense. So, we do think that there continues to be opportunities in tech, but you got to be much more surgical as you decide on it. And there's this theme about broadening out, but you also got to keep in mind that the broadening out companies are much more cyclical in nature versus the Mag 7, which are more secular.
Well, then what do you think drives the growth for 2026?
Yeah, we're looking at more of the underappreciated kind of where the relative valuations really haven't outperformed sectors like staples, sectors like communications, real estate potentially. We think that those are areas where you could see the multiples actually expand. I think the tech trade continues to stay alive and well for the sole purpose of that liquidity will continue to be the fuel to the engine for 2026. There's no signs of that liquidity, at least from this administration, drying up anytime soon. Obviously, you have the deregulation on top of that. But at the same time, you have to look at, the equities market is a sentiment gauge, but you have the fixed income market, which is more of a fundamental gauge. And, that continues to show signs of worry with rising yields. So, we think 2026 is going to be much more challenging than 2025.
When you're talking about what happens with the Fed and whether there's going to be more support put into place, it looks like there's a lot of investor pressure for the Fed to reintroduce more liquidity, to have capital flowing more freely. Do you anticipate that happens with a change of leadership?
Yes. At the end of the day, I think it's a political game, and there will be a downward pressure and dovish pressure on interest rates. But what you got to keep in mind at the same time is that, the interest rates won't necessarily work the way that they have been historically from a stimulatory standpoint, because of the fact that the unemployment increases that we're seeing in unemployment are more structural in nature as a result of AI. So are we really going to get that rehiring, that stimulus, that growing investment in place as a result of lower rates? I think that's a big question mark. But I think the tilt will continue to be dovish. I think the repo markets will continue to see a flood of activity, and the money will keep pumping. But the question is, you're at 25 times, 23 times on a forward basis. It is elevated.
Yeah.
Growth rates, I mean, you saw what happened with NVIDIA, with Broadcom results, with growth slowing down, what can happen to these multiples. And the point of concentration, you have half the NASDAQ in the top 10 and 40% of the S&P.
Are there names or sectors that you don't want to be in for 2026?
We're underweight mostly financials. We think that trade got ahead of itself. I think a lot of it is priced in at this point. So that's not a place that we're going to be overweight. Now, I would caveat and say financials that have exposure to shorter duration interest rates, I think could benefit, but the ones with exposure to longer duration, we're not really in. So that's one sector that we're staying away from, at least over the short term.